All righty, folks, it is that time in the month where we actually step back and we try to understand what is going on in King County, aka Seattle, Washington. And of course, we do this with the one and only and amazing Beth Traverso. How you doing, Beth?
Hi, Mike. Doing great. So nice to be back here. It's always a highlight of my week. Thank you for having me on.
Oh, the audience loves you. And they really just love the fact that you plain talk, you just kind of share what it is. And we're talking about October sales. So what happened in
Yes.
King County? Prices, inventory,
Yeah.
transactions, what's all going on?
Down, down, down. Almost everything is down. All the indicators are down. Now, part of it's we have a seasonal slowdown that always happens starting in October through December. And this is no exception to that. We did see some variations on that the last couple of years. I mean, we didn't have the big swings for a little while there, especially in those pandemic years where things were different. But we are seeing a return to seasonality where we're seeing inventory down. So active listings are down 30% year over year, 30%.
Wow.
Things were changing, were pretty dynamic last year, around this October of 2022. We were already suffering from a lack of inventory and sales going down. So we are down. So our sales are down 44% from this year in 2019 to now. So
Oh, that's interesting because
I'm
Brian,
starting to look at what we're seeing today versus what we were seeing before all of this happened with the Fed printing money and all these things that were going on.
yeah, I think the 2019 comparison is very interesting. And shout out Brian Lebo, who in my world was the first to kind of make that comparison, and he does it obviously with Las Vegas. They're down 45% today versus 2019. So it was really interesting that
Very similar
Seattle
here.
and Vegas are that similar. I mean, at least from my perspective, I don't think of Seattle, King County, and Las Vegas as having many
No, I
similarities. But
don't. So what does that say? Does that mean it's more of a national? I mean, I know there's no one
ding,
national,
ding, ding, ding,
but I
ding.
know that's what you look at is the overall. It's more than just a Seattle thing or a Vegas thing, is what that tells me. Is that
Exactly.
there are other factors that were influencing that.
Ding, ding, ding. Exactly what it tells me. When you
Yeah.
have two markets with more unsimilar than similar behaving the same way, probably
There's
more
other
national.
forces at work. Yes.
Exactly.
So our closed sales down year over year down 14%. Pendings are down about 14%. The new listings are down 20%. So we're not seeing the inventory building. It's still pretty anemic.
New listings down 20%. These are
Yes.
year-on-year numbers.
Year-on-year numbers.
New listings down 20%. And last October was not great. So you're
No,
down
it was not
20% from
great.
that.
People were reeling from, it still felt like a gut punch that people were making their plans. People start making their plans to move 6 months or so ahead of time, a lot of the time. So they were planning in 3% rates, and then the reality was now much higher at that time. And so people were really thrown by that last year. And so now over that, we're seeing 20% difference year over year. So it doesn't, interestingly, our months of inventory are up to about 1.8. So still really low. I mean, in our market, Greater Seattle, it hasn't been really high since the 2008, 9, 10, those years, when we had a lot of months of inventory, but we haven't seen that. We haven't seen huge, like 4 to 6 months of inventory. And since that time, it's been low inventory is the name of the game in our area. Probably because housing is so restricted, the number of houses that can be for sale is limited by how many can be built, and building is really restricted. I know that new construction, like comparisons to the Vegas market and Phoenix and other areas, it's kind of unlimited how much new construction can happen in those areas. Here in the Seattle area, it isn't. The big builders are really, really limited in what they can build. Sometimes they tend to do infill, where they'll buy some in areas where it's been upzoned and try to pack as many houses as they can into an existing neighborhood. Yeah. And those prices are going to be the top of the market. In our area, there is no room for affordable housing in new construction because the cost to build is extraordinarily high, where it only makes sense to turn a profit if it's at the high end of the market. So that's where we see our new construction. So it's not really as nearly as impactful as it is in some of these other markets that we hear about.
Yeah. It's really interesting to me that listings are down more than pendings, right? Listings are down 20%, pendings down 14, I think you said. And that just means there's still demand.
There is
And
still demand. I'm
yeah,
really curious to see what November's numbers are going to be, Mike, because I was just getting settled in for this 8%. Like, how is this going to
yeah.
impact things? And I did see that it was like a quiet just fell across the market where everything just got really still. Part of it's a change of weather here too. We're like, it's dark. It just feels like
Yeah.
very quiet. And all of a sudden, we weren't seeing houses going off the market nearly as quickly. Negotiations got a lot more intense. Great for buyers. They were able to get a lot of concessions, price, buy down, you name it. And then the rates went down and the headlines started to shift. It really does seem to be like the consumer psychology has a lot to do with this always, right?
It's always the consumer, and it'll be really interesting because rates were up above 8%. Everybody was talking about unaffordability, and then starting last Wednesday, rates bam, bam, bam went all the way down to 7.4. I don't think 7.4 is low enough to really unlock meaningful demand. Maybe at the edges, a little bit. But if we get below 7,
if we get below 7, and if I could talk to the me from 2 years ago, I'd be like, what? But if we could get to the
yeah,
I thought we'd be talking about 6.9 and being like, that's what's going to get buyers off the fence and spur sales activity. I probably that would have been hard for me to wrap my mind around, but I do
yeah,
believe that because there's a conditioning that happens.
yeah,
And I'm sure there's
exactly.
some sort of, I've heard there's psychological terms for like where you get set on certain numbers mentally and
Anchoring. It's called anchoring.
Thank you. Yes. So they're anchored at certain numbers. And for a while there, that anchor was 5, I remember. And then it went up to 6. And then now it might be 7. And 8 was definitely, whoa, we're out of our comfort zone there because we've been running our numbers and looking at our payment at this number. And now we can't afford to buy that house anymore. The only way we can do it is if we offer significantly less or request a huge rate buy down or any number of things to try to drive that payment lower. I don't think going to 7.4 is going to make a huge difference. But I do think at 6, especially if we get down to the mid 6s, I think here's what I'm starting to see a possibility that this next spring selling season is going to be a busy one potentially. It's hard to predict a few months out, but I don't like to go more than maybe 3 months out at most with my predictions. Could be wrong.
Oh, come on. I like a year. Let's go a year.
So, but I do think that, it's in my market in the Seattle area. We've talked about how for us, the springtime really starts in late January. And I already have a lot of people talking to me now about, should we list now or should we wait until after the holidays? And there's always that conversation starting to happen, which we're going to see inventory drop even more, which always do in November, December. But then if people are bringing that inventory on in January or February and our rates are dropping at that time, and by the time mid spring rolls around, our peak months of March and April, and if that aligns with the rates going into the 6s, that could be a little bit of a tinder.
No, that's exactly what I think is happening. And Joseph Wang, the Fed guy, who I interviewed last week, kind of brought that to my attention. And I now agree that we are at least at risk of significant home appreciation because I think I've said for a while the housing market's broken. You've heard me say it 100 times, I'm sure.
Yeah.
But I now think demand is constipated. I don't know how else to call it. It's stuck. And the thing that's going to unlock this is rates below 7, and maybe it's 6.5. But there's some number where demand comes out. Because again, I've been studying the consumer for 30 years. And here's the secret about consumers. Everybody wants a deal. Everybody wants to feel like they got a good deal. You don't feel like you got a good deal at 8%.
No.
I'm willing to argue you don't feel like you got a good deal at 7.4%. But do you think you got a good deal at 699, 675, 65? Somewhere in there,
Mm-hmm.
enough people will come off the sidelines because, to your point, we have kindling and it just needs to be a small spark and things could get wild in 2024.
Yes. And I've seen that coming before in the past in different scenarios. And there are people out there that will say, well, you're a real estate agent. Of course, you're going to say that, the market, it doesn't matter to me. Whether the market goes up, down, or sideways, I'm just here to interpret it and to advise based on my experience, and people should do what's best for them. I'm not saying anybody should buy or not, but I think that it is going to impact the market overall when those rates do start to come down, because the talk has been of that for a long time. I think loan officers are going to be in short demand because so many left, and the demand is going to come back and people are going to start doing refis. If people were buying at 7.5, let's say, or 8, and then it goes down to 6.5, all of a sudden there's going to be refis happening out there.
Could be. Exactly.
So
could be.
Seen it happen before. So people don't necessarily wait for it to go all the way down before they refi. If it's a 1% drop, they'll probably start refining then. I remember back when I bought my first house, again, I'm old when it comes to these things, but it was 9 something. I don't remember, and I remember it came down to 8 and I was like, wow, it's 8. And I refied, and then it went down to 7. Like, wow, great. I'm refining again. I must have refied 3-4 times, because they make it so there's like no cost refis. And why not? My payment goes down. Love it. I was house hacking at the time. So it's like, wow, I can make money to live in my own house. This is beautiful, so
there you go.
People are going to be doing that. And there's going to be demand for a lot of these loan. I'm expecting there's probably going to be some sort of a catch-up time period that's going to need to happen, where all those people that left the industry are all of a sudden the ones that are still there.
Where'd they go?
Going to be really busy.
Yeah, there you go. Well, hey, we've talked about King County, Seattle, inventory, pendings, transactions. I don't think we hit price yet. What did price do?
Yeah, so price is down 2.2% year over year in King County. In Seattle, they're down about 5% year over year in the city. And then on the east side where I am, it's up 5.5%. So, even within your submarkets. So I know you've talked about other markets being sort of like the canary in the coal mine that tell you what's coming, like Vegas again. For me in the Seattle area, it's the east side always seems to react almost lightning fast to any kind of swing or shift in the wind. We feel it first, like our prices drop first, our inventory retracted first, all this way before Seattle. And then now we're going back the other way a bit. So, but we've suffered longer, harder, and faster. Like we got hit first, we went down the most, it lasted the longest, and now we're pulling out of it. And there's certain areas within the east side where I could tell if something's going to happen. If there's certain areas where all of a sudden we were getting 5-6 offers and now there are no offers and there's price drops, it's like, okay, that's going to start happening everywhere now. But now we're seeing that, okay, some of those areas, the prices are holding steady and even moving up. And that's why I would say for people that are watching, it's important to really keep an eye on your submarket, whether it's through your agent who's your trusted advisor, or even just watching your alerts that come in. I know I get alerts on my phone every day and I look at them. It shows I'm watching certain, okay, so I don't want to go off on a sidetrack, but I am hoping at some point to have a winter house in Arizona. So I'm watching certain markets down there. And I don't have access to the MLS, but I do see like, oh, all of a sudden I'm seeing price drop, where I wasn't seeing that before. And so I'm just I'm just lurking in the background, just watching where I can see, okay, their market is coming down right now. So I can see, just keep your antenna out there and watch for those micro trends in submarkets, because that's when you'll get a better idea of the temperature of what's happening in those areas.
Absolutely. Well, Beth, you are amazing. Most importantly for our audiences, not only can you help people buy and sell in King County and frankly, the entire state of Washington, but you have a referral network because you are a top 1% agent around the country. So if somebody wanted to get said referral or buy or sell in King County, what should they do?
Yeah, if someone wants to reach out to me, connect, I'd love that. I've connected with lots of people from the One Rental at a Time community, and what a great group of people it is. I can be found at Beth Traverso Group submarket.com, or just Google my name or find me on social media.
Thank you so much.